Hello, this is Kevin Prince from BMO Exchange Traded Funds, and I want to say welcome back to our weekly show on Market Insights, our webinar we put out there. And I'm keen to do this one more time. Each week we keep building and building, and really it is based upon you, the users, that effectively dial in and give us your questions on a weekly basis. It helps drive the overall content. Our content for this next 30 minutes is going to focus in around fixed income, and we're going to dive into the topic with you. And as we get in there, I'll quickly highlight that at the end of this session too, there will be a survey. And in there, of course, you can always send in your questions, as well as the announcement we send out each week. Send in your questions, because it really does help us put together content each week. With that, let's get started. Of course, if you've been in this session before, we talked about our disclaimers. Our disclaimer simply are saying to you this time is, effectively, this is not advice. This is market insights, as well as I'll say one on behalf of FTSE too. This is not recommendations. This is market insights, and we're pleased to provide that to you on a weekly basis. Now, I get the pleasure here of introducing Robin Marshall, coming in from FTSE Russell. He's the Director of Fixed Income Research for FTSE Russell. Really pleased to have you on today. And also, of course, join us one more time, Mark Rays. Good to have you back in the session. Thank you for joining us too.
Thanks, Kevin. Happy to be here. Thanks, everyone. Kevin.
Yeah. Thank you, guys. And then quickly highlighting here, let me go right to Robin, for example, because you know what? FTSE, of course, is really known as a British for its background in England. But, with your relationship with Canada and the index you provided, maybe you want to give us some history of FTSE Russell inside Canada.
Yes, thanks. Thank you very much, Kevin, and thanks everyone for dialing in today. As you may know, the FTSE Canada fixed income indexes go back a long way to the early 80s, in fact, when they were originally Scotia Capital launched their fixed income indexes, and since then, as you can see from the chart, in our history of innovation, it's been a long process of development, research development, and performance attribution developments over that period, and that's taken in some important landmarks, including the performance attribution 2003, when we introduced bond perform. Then, of course, we had the first fixed income ETFs 2004, and then we rebranded in 2013 to FTSE TMX Canada, and then more recently, FTSE Russell acquired the Citi fixed income indexes and yield book and expanded the fixed income analytics. So it's a long and distinguished history, we like to think, producing indexes and measuring performance and returns across asset classes in fixed income against those indexes. It is the most widely used bond index. Canada Universe Bond Index Series is the most widely used performance indicator of marketable government and corporate bonds for Canada as well. So that's our history, and perhaps I could also add that we do commit a fair bit to fixed income research for Canada, including as you can see in the next slide, the fixed income overview, fixed income research papers, and indeed our regular blog posts, including a number recently on the COVID-19 impact on Canadian fixed income and the lockdowns on Canadian fixed income, and indeed another one on whether this story is going to end with helicopter money, which we might come on to later, and indeed developments in fixed income in credit markets, including high yield. So we have a broad reach in our fixed income research, and hopefully, we like to think, a distinguished history of fixed income index development in Canada.
Very well said. And I highlight to all the listeners out there, take a look at that FTSERussell.com website. You'll find this information right on that website. So good resource for everybody out there who wants to dive deeper into the fixed income universe in general. And thanks for that, Robin. Now, we're going to have Robin back in a little bit, give us kind of a market update in regards towards fixed income, specifically here in Canada. But let me just dive into a little bit deeper around the fixed income market from a user perspective. And let me first bring it into Mark. We're certainly seeing flows into fixed income the last while. Maybe just a little kind of comment here. What's going on in the fixed income markets? We're certainly seeing equity flows, but still fixed income flows have been strong in the Canadian marketplace. Mark, what kind of flows and why do you think that's still going on in these markets?
Sure. Thanks, Kevin. And once again, thanks everyone for joining today. Really appreciate your time here on a Friday. If we look at the ETF market, it's not just fixed income, but it's actually been record flows year to date across the Canadian ETF market, which, speaks to the benefits that we know of ETFs, the transparency, the tradability, the efficiency and the low cost, all those good things we think about. And when we take those benefits and apply them to fixed income, they become that much more pronounced because you're taking a OTC asset class, an over-the-counter asset class that is difficult to trade, is not as transparent as equities, and putting it right on the exchange with a single ticket solution. So in a market like today's and in this year's, where there's been a lot of volatility and therefore a lot of rebalancing and repositioning of portfolios, ETFs are one of the best tools out there to have a single ticket adjustment to the portfolio. So you see that across user types, rebalancing by adding term, subtracting term, adding credit, adding higher quality or lower quality credit, but as well using aggregate bonds. And so Robin touched on the aggregate bond index series off the top. Those aggregate bond ETFs like our ZAG, BMO Aggregate Bond ETF, give the entire Canadian investment grade universe an incredibly diversified exposure at only a very minimal management fee or MER. So, when bond yields are low, of course, you want to keep your costs to a minimum to offset that. So lots of good reasons why ETFs have been working. It's really a combination of strategic buy and hold and tactical trading as we see this volatility. Thanks, Kevin.
Oh, thanks for that, Mark. And I want to stay with you for a second because you mentioned ZAG. Sorry, the broad market. I'm going to talk about the ETF. That's my apology. There are other choices out there too. And I put a slide up here, and really, can you, one of the things I thought when we put together the slide is to see the percentile performance relative to other choices in the marketplace, active, passive, works. You're seeing strong movement, strong performance across the board. Now, why do you think you tend to see, the broad market fixed income do well in most markets out there?
Sure. I think the starting point is to recognize that they're incredibly low fee, right? You're seeing, a management fee of only 8 basis points on ZAG to get an investment product that, accesses over 1,000 bonds. That's pretty incredible. And then when you look at the performance, all three that we have on the screen here are aggregate bond or universe bond exposures. So you see consistent results, but you see first quartile results. Why? If you look at it compared to active management, you want it to be active. So if you have a manager that's just sitting on shorter duration or higher credit and not moving the portfolio over time, you're not really getting the benefit of a lot of outperformance across different market environments in your portfolio. So an aggregate bond exposure in an ETF format, low cost, diversified, full market, will consistently deliver returns against an investment universe that if, certainly there's some active managers that do really well, and I'm not speaking against that as a whole, but by and large of the universe, they tend to be less active, and therefore the ETFs with the low fees rise to the top. Thanks.
Thanks for that, Mark. And really, here's an interesting chart. And thanks again, Mark, for your team putting this together. I think this really speaks to the performance in the fixed income space, because what you're seeing here is the market movement. We call it a jelly bean chart. Sorry, everyone. And it just looks like a bunch of jelly beans. But ultimately, what we're trying to highlight here is that different parts of the fixed income market perform at different times well. But the one part I want to highlight here is that middle line there, cascading across, kind of showing ag, it constantly in that space. And Mark kind of highlighted the performance-wise a second ago, but you're seeing it not always the top, not always the bottom, just constantly hovering that middle space. And Mark, maybe you can talk to the diversification with inside, the broad market, and why you're seeing that kind of that middle ground across the performance.
Sure. Well, there's going to be two main drivers in fixed income. First, of course, being your duration or term, or how long the bonds are in the portfolio. And gradually the Canadian market has been getting longer as more issuance has come out, and the duration now at about 8.5 years. Speaking in a similar way, the term now over 11 years. So ZAG would, of course, have bonds that cover that, entire spectrum from 1 year, all the way out to bonds that are, 30 plus years to maturity. So you're getting a full spectrum of exposure that way. But then in terms of credit, you're getting federal bonds, so Government of Canada, you're getting provincial, Ontario, Quebec, etc. And you're getting corporate bonds, Bank of Montreal, TransCanada, various utility companies. You're getting a very diversified exposure. And one thing I think you always have to keep in mind with your fixed income, when the yield curve does shift down or up, of course, there's far more impact on the long end. And when these ETFs give a full market exposure, when you get a curve that's been shifting downwards over time, that's a stronger benefit return-wise on the long end. So that's the importance of having some long bonds in your portfolio to make sure that your fixed income is actually truly diversified. And you see that carry through in ZAG because it clearly does that, represents the entire market. Thanks, Kevin. Thank
you for that, Mark. And the other, I really think there is something to be said about diversification. You exactly spoke about it. Diversification, fixed income, has really shown its benefit over time. The other quick thing I want to highlight here before I move to the next slide is that correlation chart in the bottom corner there, right? That just shows the ongoing benefit of fixed income in a diversified portfolio, because what we're highlighting here is just the low correlation to any other asset class out there, the no correlation, I guess I should say, Mark. So it really is a diversifier of our portfolio. Go ahead, Mark. Yeah, please.
Yeah, it's interesting when you look at people that construct their own portfolios, in self-directed accounts. There does tend to be a higher equity bias compared to ETFs and mutual funds, where you typically see more of a balanced approach. So just adding that weighting to fixed income, depending on what your risk budget is that 20%, is that 30%, is it higher as you age and get closer to retirement, really helps to balance out the volatility in the portfolio. And you definitely note that in self-directed and overweight to equities, and as well a home market bias when it comes to Canadian equities. Thanks
for that, Mark. Now let's bring Robin back in. Let's get a little bit from your research perspective, what's going on in the Canadian fixed income marketplace, and walk us through. We're starting off with your duration and yield chart here.
Yes, I think that this kind of relates a bit to what Mark was just talking about, Kevin, in the context of movements in yields and the term and the years to maturity, or the term the term to maturity on in the Canadian fixed income space. We've got a chart here since 2002 showing how the years to maturity of the bonds in issue have increased steadily to we were just saying, a bit over 11 in the FTSE Canada Universe Bond Index, 11.2 I think at the moment, and that you can see is considerably higher than where we were back in the early noughties, around 9 years. So that's a reflection of the length of the increased duration of issuance, if you like. And meantime, yields, of course, have been falling, and that's, you can see the black line. It shows a steady decline in yields from nearly 5.5% in the early 2000s to to not much over 1%, 1.5% now, and that's a reflection really of the fact that longer dated fixed income assets are not as jeopardized now by high inflation rates either. So what we call the term premium, the yield premium that investors require to hold longer dated fixed income, has declined because the inflation that erodes the value of fixed coupon assets, that inflation has declined steadily over the last 20, 30 years, really since we started producing these indexes back in the 80s. So yields have fallen and the term to maturity has lengthened. And there are other structural drivers like aging populations, pension funds requiring more longer dated fixed income assets, which have a known coupon profile so that they can meet their liabilities to pay out pensions. So all those factors have driven quite strong demand for longer dated fixed income assets and helped to drive yields lower, not least the lower inflation rates.
Let's go through the recent fixed income themes if you can now too, because I know your team put this together. I think these are some pretty interesting points to share with the users here.
Yes, thanks, Kevin. Since in the more recent situations, been dominated, of course, by the wretched COVID-19 virus and the impact of the great lockdowns that have accompanied it, and indeed the policy responses from central banks and governments, both in Canada and around the globe. And if we look at what's happening in Canada, you can see real impact there from the Bank of Canada's quantitative easing, or QE, asset purchases, and they've helped to drive down yields on corporate credit and indeed on government bonds as well. I've got shown here the maturity matched credit spreads. In other words, the difference between the yields on corporate bonds of different maturities and equivalent government bonds. And as you can see, in the early phases of the COVID crisis in March, there was a sharp widening of spreads as corporate bonds underperformed and investors got worried about a deep recession and the impact on corporate profitability, increased credit defaults, etc. But since the Bank of Canada signaled it would start buying corporate credit, corporate bonds, spreads have come steadily lower, and in fact, the returns have been quite favourable on corporate credit. And the same situation actually is shown in the next chart, where we look at, if you could move on to that one, Kevin, where we look at the decline in credit spreads since way back in 2015-16, when spreads widened quite a bit in Canada, when oil prices fell sharply back then, you may recall. And the high yield chart is the top one, whereas you can see credit spreads moved out to over 1,000 basis points, almost 1,100 basis points over equivalent government bonds back in 2015-16. What we've seen recently is there was a pronounced widening, as I was saying earlier, in March, April, in the early days of the COVID crisis and lockdown of the economy. But since then, there's been a pronounced narrowing of spreads, or yields have dropped on high yield credit or sub-investment grade credit, and indeed also on investment grade credit. And that's partly, I think, because of what happened in 15-16, when actually there weren't the corporate defaults in credit on corporate bonds, that there weren't the defaults that were being projected by spreads. So investors have been more comfortable about buying bonds, it seems, since March than they were then, and that's helped, plus the Bank of Canada's QE program, because remember, back in 2015-16, the Bank of Canada hadn't started buying wasn't pursuing a quantitative easing program and wasn't buying up corporate credit and government bonds in the way it has since March. So these are very significant developments, and the Bank of Canada has been successful so far in putting a ceiling, if you like, on yields and helping to drive down spreads in corporate bonds. There's also been, if we move on to the next slide, Kevin, there's also been an increase in the number of, the share of lower grade credit rated triple B in the overall corporate index. As you can see, the share of what appear to be lower grade, triple B is lower grade corporate bonds. That's the lowest investment grade rating, and that the share of those issues has increased. However, it's worth noting as well that may also reflect a defensive approach by the rating agencies, who were very much caught out by what happened in 2008-9 during the global financial crisis, and therefore rated bonds more cautiously and will put more triple B ratings on bonds than they had done previously. And in the context of our FTSE Universe Canadian Bond Index, the triple B sector is still only about 12% of the overall index. Corporates have about 27% of that index, and within triple B is a larger sector than it was, but it's still relatively small. And last but not least, so far, despite widespread forecasts of that sector of triple B bonds blowing up, actually the performance to date has been reasonably favourable, and that's another factor worth noting. If we move on to the next slide, you can see also that the Bank of Canada has been successful in driving in provincial spreads, which have come in since they announced their quantitative easing program in March, April, and that involves them also buying provincial bonds of less than 10 years to maturity, and that's helped to drive in, as you can see there, the provincial spreads quite sharply after the initial spike back in March, April. We're showing in our indexes the three different maturities there, the long dated ones, 20 year plus, the mediums in the 7 to 10 year area, and the short dated ones in the 2 year area. So significant narrowing of credit spreads there in provincials as well, helped by the Bank of Canada's QE program. And last but not least, if we move on to real return bonds, I think there are some interesting developments there on the next slide. Kevin, if you could move us on. Thank you very much. It was noticeable in March, April, when there was concern about deflation becoming from the COVID-19 shock and global recession, global lockdowns. Yields on real return bonds went up quite sharply, as you can see circled in my chart. But since the Bank of Canada stepped in and started to make plain that it would do whatever it takes to avoid deflation, we've seen real yields decline on real return bonds, and they performed very strongly in the second quarter in Canada and indeed around the globe. And that may well be because investors are now seeking some inflation protection in case in the end we move to an outcome here of higher inflation rates, because central banks have to print money to ensure that these economies recover from recession in 2021, and therefore they want more inflation protection, and hence there's been a willingness and enthusiasm to buy real return bonds to diversify portfolios and seek more investment and seek inflation protection.
Rob, that's absolutely appreciated. I mean, it's really good to get your research and get your insights, what's going on in the fixed income market, especially here in Canada, of course. And thanks for jumping on the question too on the real return bonds too, because we certainly have some people asking about is, the time for the real return bonds out there. Now, Mark, let me go to you for a second here. and let's talk a bit about fixed income in general in the context of portfolio construction, because when you think about it here, we talked about ZAG, we talked about different aspects. Robin's given us an aspect of what's going on in the marketplace. And next week, we're going to talk about being tactical in fixed income, but maybe give us a little bit of thoughts on put some structure around fixed income and inside somebody's portfolio.
Sure. Thanks, Kevin. If people are looking for ways to really implement fixed income ETFs in their portfolio, let's assume you've got a heavy equity portfolio. I think a core and explore type approach is really an easy way to get started. So, you add some discipline by adding an aggregate exposure, again, like ZAG that we've talked about here. And that really is the anchor to your fixed income portfolio, whether that's, half of it, 75% of it. It really depends how tactical and how much you like to trade beyond that. But then you can use other ETFs, again, to lengthen the duration, shorten it, add corporate exposure, or if you add government bonds, reduce corporate exposure. So we're giving a few examples of the types of ETFs you can now access using our BMO lineup. So ZQB is quality bonds. That means investment grade bonds, but not including triple Bs, only 1 to 10 year in length. That's offset with ZBBB, which is just the triple Bs, so a different sleeve that you can add. Down below that, just government bonds or just short bonds, ZSB, or even up in the top right, corporate bonds through ZCB. So as you can see, depending on how optimistic you are, how pessimistic you are, whether you think markets are going to keep roaring forward or whether you think that second wave is going to hit with COVID-19, you've got tools at your disposal using ETFs to quickly shift your fixed income exposure or get ahead of what you think is coming. So hopefully that's a helpful explanation. Thanks, Kevin.
Thanks, Mark. And again, we'll spend some more time on being tactical in fixed income next week, and we'll have FTSE join us one more time. Let's jump into a few of the questions that came in there, Mark. One really actually interesting, because this just happened yesterday, and I can sure tell that the listeners out there are really current with the marketplace. You know what? They saw that the preferred share market, specific ZPR, and sometimes we can think of preferred shares as kind of a quasi fixed income. We certainly see it pop yesterday. Mark, maybe you want to give us a little background. What's going on in fixed income? Why are we seeing the pop more recently?
Sure. Well, yes, whoever sent this question in is really on top of markets, because this was just yesterday where we saw that Royal Bank came out with a very innovative fixed income issue. So they put out a new bond, which actually, without getting into great amount of details, has a lot of the attributes of preferred shares. So in doing so, the market responded by thinking, well, if all the other banks follow suit, if this is successful, we'll see a bunch of these new type of bonds come out, and retiring of preferred shares because they won't need that higher cost capital. So as such, that creates the idea out in the marketplace that preferred shares will come back in at par, $25, and as well on a go-forward basis, there'll be less availability of preferred shares, both those things causing the preferred share market to pop yesterday, to jump up. So it's a really interesting point in fixed income and preferred shares. We'll see what this first issuance leads to, but it's certainly an indication that the market might be getting changed up.
Well, thanks for the insight there. It's a dynamic market. Always see it changing. So, yeah, and good to see the listeners or watchers are current on the markets there. One of the things we get on a regular basis is we certainly put up a lot of supporting materials in these webinars. One of the users here, of course, is saying, or listeners here is simply saying that we put up a lot of our guides and information on our website. Is there a place to find this information on your website? Where do I go? Mark, maybe you can quickly walk us through that.
Sure. Well, yeah, if you've been on a few calls, you noticed some of those diagram boxes look similar. We're just picking them up off what we call our ETF roadmap. So that's our document that really lists out all the ETFs with their key attributes. So you of course can find that on our public website. If you simply just go right to the product list on BMOETFs.com, you can see here it's been boxed in a red square. You can get right to our roadmap. That's a great indicator of the entire BMO ETF lineup. And if you want to look outside of BMO, you can go to our tools, which is the second thing indicated on this slide, where we have some comparison and screener tools that aren't just BMO ETFs. It's all ETFs here in Canada. So again, you can compare and contrast across providers using those tools. Thanks.
Thanks for that, Mark. And thanks for sending the question in too. A couple more questions for you. First and foremost, around ZPay and ZPay.F. The real question is, the one's hedged, as we know, and one's not hedged. But there's a difference in price, which looks to be a difference in yield. Like, why is there a difference there, Mark? And give some background there.
Yeah, just keep in mind that these are separate series, so you're not buying the same series. So because of that, price is a little bit arbitrary, but they are distinct. But they are both investing in the same portfolio. So if you put $100 into either one, you're getting that same exposure. One obviously with the currency hedge attached to it. So don't get caught up on lower price. That's a bit of a red herring. The yield you're going to find between them is pretty consistent. I'm actually the guy that sets them, so I deliberately look to keep them pretty close. There might be a little bit of frictional difference between the two, but I will probably clean that up over time because, again, they're investing in the same portfolio. So don't get lost on the price difference. Just like how, let's say, for S&P 500, our ZSP might have a price around 50, and SPY down in the States might have a price of about 300. You're really buying into the same thing, and that price is much more of a arbitrary amount, which just reflects in the number of units. Hopefully that makes sense. Thanks.
Certainly does. Thank you for that, Mark. And I'm sure you're going to get a question next week about how you set the yields. I'm sure that's coming, my friend. Really staying close to that currency conversation again. And this is interesting too, that people are looking at quality. Actually, this leads into something that might be a nice development for next week, because somebody likes our ZEQ ETF, but wants to move into ZUQ, but really wants the hedge version of that. Maybe Mark, you want to talk to us about that?
Sure. Yeah, over time, we do look on international exposures to have hedged, unhedged, and even US dollar where we think there's demand. So this particular ETF, US quality, I'm actually happy to let you know. We were just preceded by the OSC on an amendment just yesterday, where we're going to go ahead in the next few weeks and add both a hedge series and a US dollar series. So, we know quality investing has really been catching a lot of investor interest. The returns year to date through the market turbulence have been quite excellent. So we know why the demand's there. So we're happy to meet that head on. And within hopefully a couple of weeks, we'll have ZUQ.F and ZUQ.U if you're looking to invest with different currency approaches. Thanks.
Thanks for that, Mark. I appreciate the insight and the early insights in the marketplace. Now, what I'll highlight is we're going to be back again next week at this exact same time, 1 o'clock for the same time, 30 odd minutes. I really appreciate Robin joining us for this session. We're going to have FTSE join us one more time for next week's session too. In between now and then, have yourself a good week, and we look forward to your questions coming in, and we look forward to hearing from you at that time. Thanks again. Have yourself a good week ahead.
Thank you.